We will be covering the accounting procedure for the dissolution of a partnership in this video. Dissolving a partnership means the partnership comes to an end and the business ceases operations. The accounting procedure for a partnership dissolution comprises of 5 steps. First, we will transfer all the assets and liabilities balance, with cash being the exception, to an account called realization. Next, we will record cash received to sell the assets and cash paid to settle a liability. After that, the realization account will have a balance because the assets and liabilities book value is probably different from the fair market value. The realization account balance will be allocated to each partner's capital account based on the partner's profit sharing ratio. Each partner's current account will be offsetted to their capital account before the partners can claim their remaining share of capital. I will go through the journal entries for each of the 5 steps. Starting with step 1, we will transfer all assets and liabilities balance except cash into a realization account. This realization account is a temporary account used to aid the dissolution process. To transfer assets, we debit realization and credit the respective assets by their book value, the figures appearing in the balance sheet. To transfer liabilities, we debit the respective liabilities and credit realization, again by their book value. Step 2. We will record cash received to sell the assets and the cash paid to settle the liabilities. Debit cash and credit realization to record cash received from selling the assets. To record payment of liabilities, we debit realization and credit cash. Sometimes, a partner may take over an asset instead of selling it. In such cases, we will debit the partner's capital account and credit realization by the value of the asset the partner agrees to take over at. In the process of dissolving a partnership, the partnership will incur administrative expenses like the lawyer fee, liquidator fee, or the fee paid to the accounting board for dissolving the partnership. The journal entry to record dissolution expense is to debit realization and credit cash. This is the same journal entry as that to record payment of liabilities. Since the book value of the assets and liabilities is often different from the fair market value, the realization account will arrive at the balance after recording the journal entries for step 1 and step 2. Step 3 is to allocate this balance to each partner's capital account according to their profit sharing ratio. The journal entry is as follows. Usually, the realization account will end up with a debit balance, unless the partnership somehow managed to sell off all assets above book value and pay off all liabilities below book value. Anyway, if the realization account has a debit balance, we will debit the capital accounts and credit the realization account to zero off the realization account. In the rare event that the realization account has a credit balance, we will do the reverse journal entry, which is to debit realization and credit the partner's capital account. Once again, please remember to allocate the realization balance to each partner according to their profit sharing ratio. If the partnership agreement states that profits are to be shared equally, the realization balance will be allocated equally among all partners. Moving on to step 4, we will offset each partner's current account to his capital account. The journal entry is pretty straightforward. Just debit the partner's current account and credit the same partner's capital account to zero off his current account balance. This is if the partner has a credit current account. In the event the partner's current account has a debit balance, we will enter the reverse journal entry, that is, to debit capital and credit current. In the last step, we will record the cash distributed to each partners. The journal entry is as follows. Debit capital and credit cash to zero off the cash and capital account. If the partner ends up with a debit capital balance and the partner is still solvent, he will need to contribute cash back to the partnership to clear his capital account. We will debit cash and credit capital in this case. So here are the 5 steps to account for a partnership dissolution. If you have done all 5 steps correctly, you will zero off everything. Literally, all accounts. The realization, capital, current, cash, and all other accounts should arrive at a zero balance. When everything is zero, we can safely declare that the business has ceased operation. In the next video, we will go through a work example to apply these 5 steps and account for the dissolution of a partnership.